Watching the banks, helping us to break down what we've gotten so far this morning is Erika Najarian, UBS large cap bank and consumer finance analyst, joins us this morning. Erika, thanks for the help today. Busy day.
Very busy day.
I wonder if you can help us. Some of the qualitative stuff coming out of JP Morgan, almost even a split between Diamond's view and the CFO's view about the future for employment and hence credit quality. Are you surprised by anything we've gotten today?
I'm not really surprised, but I think given the tricolor and other bankruptcies out there in the market, investors are definitely more skittish. And I think that you might be seeing, in the reaction today is clearly the quarters from JP Morgan, Goldman, and Wells Fargo could be called standout, especially in some cases. But I think now, especially with some of the policy overhang, investors are wondering, what are we missing? Is there a turn in credit that's about to come? And a lot of the conversation that's happening, Carl, is not as much about the consumer, and it's really about non-depository financial institution or NDFI lending. That's banks essentially lending, to shadow banking, and shadow banking is in turn lending to the companies. I think that was a big part of the discussion in a JP Morgan call. And I think the quote from Mr. Diamond is that if you see a cockroach, there could be others. And so I think that has been, a big part of the investor discussion coming out of the conference calls. Yeah,
he added, and so everyone should be forewarned. Is that going to color your thesis or view?
Look, we have to. Let me put it to you this way. Revenues could be awesome from investment banking, loans could be growing, but credit quality deteriorating is the single most important and overwhelming catalyst for banks and bank stocks. So it is very clear that if there's something in the air, that's something that we should consider as we think about the go forward for these stocks. So NDFI, according to regulatory data, is now 14% of money center and large regional loan books. And like I said on the JP Morgan call, I don't even know what questions to ask about NDFI exposure as this has grown significantly. So this is certainly, something to watch. But the great news is that the banks are extraordinarily well capitalized. They're earning a boatload of money, which is the first line in defensive credit. And we'll see if there is a downturn who the good underwriters are versus the not so good underwriters.
Is this a reserve build at JPM notable, or is that sort of within the realm of sort of reasonable quarterly business practice?
Yeah, really good question. I think that's pretty reasonable. Keep in mind that they did launch, Sapphire Reserve, which CFO Jeremy Barnum said that it's their best quarter for net new account originations ever. And so when you put on new credit card loans or new credit card lines, that does have a pretty high reserve attached to it. So that's normal course of business. I think what everybody's looking forward is looking beyond the numbers that were posted this quarter and making sure we're assessing all the risks for the industry going forward.
Right. Is the Wells story simply a matter of having the shackles unleashed?
Yeah, absolutely. I think, first of all, with the asset cap behind them, investors were saying, we'd rather be long other stories, like a Citi or a B of A heading into the print. But what their outlook for returns on equity, which they said was 17 to 18% on a tangible basis, and the net interest income for the fourth quarter is saying to us, look, it is a big deal that we can grow our balance sheet. We could actually grow customers without any shackles. And that's going to deliver, better returns on capital. So I think we're just starting to see the beginning or the early innings of what new Wells could be in the future.
Why, just cut back to JP Morgan to end here. It's not unusual for it to be down on earnings. I feel as though oftentimes they report a number that's fairly well reviewed, stock goes down, and then during the course of the quarter, it moves up again. But is there anything else you think that is responsible for that decline of, 3.5% or so this morning?
So I think investors had probably, cleaned up short positions, very technical thing yesterday. Sort of anticipating a better revenue print. And as I just think about the forward outlook for next year, they're pretty conservative. They tend to be conservative in their outlook. And essentially, they said that consensus is pretty much in line for net interest income, but consensus was a little bit too high for expenses. And this is an interesting to note as you think about your broader discussion, David. They essentially said that 3 to 4% is a normal rate of, labor market inflation in terms of comp expenses. But again, I think the phrase, if there's a cockroach or other cockroaches elsewhere, could not have made investors feel great. But I'm surprised that read through is to the stock of what we think is probably the best risk management out there versus hitting the rest of the group.
We'll look forward to Morgan Stanley BofA tomorrow, Erika. Thanks for the help. Good to see you as always, Erika Najarian.
Absolutely.